Welcome back to Ingenious Accounts World. In the last video, we have discussed about the traditional method of classification of accounts. Today it's about modern method of classification. In this method, accounts are classified into 5 categories: assets, liabilities, capital, revenues or gains, and expenses or losses. First one is assets. Assets are the properties or possessions of a business and includes all types of assets like cash, bank balance, land, building, plant and machinery, all types of assets. Next one is liabilities. Liabilities are the amounts payable by the business. It includes both long-term and short-term liabilities like bank loan, bank overdraft, and expenses outstanding like salary outstanding, wages outstanding, rent outstanding, etc. And the third one is capital. Capital means the amount invested by the proprietor into the business. This capital is also a liability to the business because of business entity concept. Business entity concept makes it clear that business is separate and business person is separate. So, capital is also a liability. Now the fourth one is revenues or gains. Revenues are the amounts earned by the business by selling goods or by rendering any service. Interest received, commission received, rent received, these are all examples of revenues. And the last one is expenses or losses. Expenses are the cost incurred to earn these revenues, like salary paid, wages paid, rent paid are all expenses. Okay, these are the different types of accounts. Now the rules of debit and credit for these accounts. Here, the rule for assets and expenses are the same, and it is assets and expenses increase debit and decrease credit. That is, if there is any increase in the value of any assets or expenses, debit that account, and if there is any decrease in the value of any asset or expense, credit that account. Purchase of a land means increase of an asset, then debit that land account. Sale of machinery means decrease of an asset, then credit that machinery account. Salary paid means increase of an expense, then debit that salary account. Assets and expenses increase debit and decrease credit. The next one is liabilities, capital and revenue. The rule for these three also is same, and it is just reverse of assets and expenses. Here it is increased debit, but here it is decreased debit. Here it is decreased credit, but here it is increased credit. For example, repayment of a loan means decrease of a liability, then debit that loan account. Salary for the month of March is outstanding. That means increase of a liability, then credit that salary outstanding account. Additional amount invested by the proprietor into the business means increase of capital, then credit capital account. Interest received means increase of revenue, then credit that interest account. That is, liabilities, capital and revenue, decrease debit and increase credit. These are the rules of debit and credit. Okay. Now, if you found this video helpful, please like, share, comment and subscribe my channel. Thanks for watching. Thank you.